How worried should we be about the health of the economy? What should we make of slowing growth in China, difficult economic conditions in the Eurozone, and an uncertain future for monetary policy? And what could all of these mean for the performance or even the stability of the financial sector? I'm Scott Martin from Deloitte Center for Regulatory Strategy, and you're listening to Regulated Radio. I've got Ian Stewart, Deloitte's chief economist, with me here today to scan the horizon and discuss his view on the top economic threats facing the financial sector. We'll be talking about the latest macroeconomic developments in the UK, Europe, and around the world. What risks central bankers and financial regulators are most concerned about this year, and what you should expect to happen next. All this coming up in the next 20 minutes or less. This might just be one of our biggest episodes yet. So get ready. This is Regulated Radio. It seems that global economic growth is starting to slow down. The International Monetary Fund just recently downgraded its forecast for global growth to 3.3% in 2019. That's only the third downgrade they've made in the last 6 months, and their lowest global growth forecast since the financial crisis 10 years ago. Financial regulators need to take note of these trends. They regulate, after all, to make firms more resilient to external shocks, including economic ones, and they know that difficult economic conditions can quickly affect the commercial sustainability of the firms that they supervise. Now, bodies like the Financial Policy Committee in the UK and the European Systemic Risk Board in the EU closely monitor economic trends and consider very carefully whether regulatory policy needs to be tweaked in order to respond to risks that they feel are growing. So, what are those risks? Well, I'm very excited to have Deloitte's very own UK chief economist, Ian Stewart, joining us on the show today. Ian has been with Deloitte since 2007, and before that was European chief economist at Merrill Lynch. He spends his time talking to our clients about economic policy and trends, and he also publishes our quarterly survey of chief financial officers. Ian, welcome to Regulated Radio.
Great to be here, Scott.
So Ian, we're now more than 10 years removed from really the worst of the global financial crisis, and we've been talking about an economic recovery for quite some time. I'll start off with what could be a very big question, but what's your take on the current outlook for global economic growth?
Well, to me as an economist, two things strike me about growth, the growth that we've seen since the financial crisis. One is that growth in the rich world, in the industrialized world, is running at lower trend levels than it did before the crisis. So the speed limit for the rich world in terms of growth seems to have dropped. And the second thing is that China, the world's second biggest economy, its trend growth rate is slowing, from the kind of 10% plus rates we were getting in the good years in the 80s and 90s to more like 5 to 6%. So those two factors mean that we're looking at a world which over the cycle is going to run, where growth is going to run at lower levels. Now, the economic cycle's not dead, and actually 2017-18 were good years for global growth. But this is a mature recovery. In some countries like Germany and the United States, capacity is in quite short supply, and a slowdown is underway. And I think the debate has shifted from whether the slowdown will come or not to how fast will that slowdown take place. It's certainly come quicker than expected, particularly in the euro area. My feeling is that there is going to be a continued debate about whether this slowdown is going to end up either with a much, the sort of thing that economists love to imagine we can pull off, a soft landing, or whether we end up with a recession. And of course, most recessions occur because economies run out of spare capacity, growth slows, and you get some sort of financial crisis or a balance sheet crisis exacerbating a downturn. And I think there's going to be a big focus on whether we start to see some of these risk factors in the global economy emerge in the second half of 2019.
All right, but if we zoom in from the global level to the economic performance of Europe or the Eurozone, what are some of the most notable trends that you're seeing emerge this year?
Well, the euro area is the part of the global economy which has given us the biggest surprise over the last 12 months, and it's a negative surprise. The euro area growth has slowed really quite appreciably. Key to that has been a shift in the outlook for the German economy, the poster child of growth through 2016, 17 and 18, now really much weaker, even talk of the possibility of a German recession. And that reflects the fact that Chinese demand has weakened. Protectionism is affecting Germany, which is a very export-dependent economy. The emissions scandal in the auto sector has been bad news for car production. And frankly, with unemployment at the lowest levels in pushing 40 years in Germany, they're just running out of capacity. So the German economy has slowed sharply. The other big player in terms of this slowdown in the euro area is Italy. Its economy fell into recession in the second half of last year. General expectation is Italy will not grow at all in 2019. So I think the reason the European Central Bank has changed tack on monetary policy towards easing, having announced at the end of 2018 that policy ease was over, was precisely because of the scale and speed of the slowdown in the euro area economies.
So, Ian, just following up on your remarks about Italy, but specifically about Italian banks, we've, of course, all seen the very well-publicized difficulty that the Italian banking sector has had in emerging from the financial crisis. Do you think that it's going to be able to manage slower Italian growth over an even longer period now?
Well, this is one, I think, of the key risks in the euro area. The Italian government runs high levels of debt relative to other major industrialized countries. A lot of that debt is held by the domestic banking system. What that means is that an outbreak of concern about the solvency of the Italian government feeds through to the balance sheets of Italian banks and could restrict their ability to lend and keep the economy going. And of course, it was those sort of concerns which were behind the euro crisis. There has been considerable progress in cleaning up the Italian banks' balance sheets. But I think there are two key risks. One is around politics, that the government of Italy increases public expenditure and debt accumulation. And the second is around weak growth. The combination of weak growth and high debt levels are clearly risk factors for sovereign debt and also for the banks.
So, Ian, if we step back and think about economic risks from further afield, China rightly gets a lot of attention given the effect that economic performance there can have on economic outcomes all around the world, and particularly in exporting economies like many in Europe. What are you seeing right now, and just how exposed do you think European economies are to slowing Chinese growth?
Well, of course, the German economy is the world's great export machine. It has the largest current account surplus of any country in the world. And if you look around the euro area, Germany is the country which has the biggest export exposure to China. Particularly given that China tends to import disproportionately industrial products and manufactured goods. Germany is the world's workshop for such products. So part of the slowdown we're seeing in Germany has been triggered by this slowdown in China and a weakening Chinese demand. So, I mean, I think, Germany really is the country which is on the sharp end in Europe of the Chinese slowdown.
All right, but still thinking about big potential risks coming from outside of the traditional financial sector, I wanted to ask you about the market for leveraged loans to highly indebted corporates. Now, this is something that we've seen regulatory bodies like the Bank of England and the Financial Stability Board increasingly point to in the last year as a growing source of concern for them. And of course, this is something that we've seen the FSB launch an inquiry into at the international level, which we're expecting to see them report on later this year. Ian, how much of a risk do you think this really is to the financial sector?
Well, I think it's one of the top three risks to global financial stability, along with the state of the Italian banks and Italian government debt and indebtedness in the Chinese corporate sector. So I think leveraged corporate loans are an important area to watch. And I think, it's interesting to see what has happened since the financial crisis. I mean, 8-10 years ago, the Bank of England and other central banks were very keen to see increased lending by non-bank lenders to the corporate sector, to fill the gap created by the banks, and indeed that is exactly what has happened. And of course, this is history repeating itself. I mean, you often have this phenomenon where a financial crisis takes capacity out of part of the financial sector, creates incentives for lending outside the regulated sector. And this is exactly what has happened with leveraged loans. I think the real issue is the distribution of loans, and particularly amongst companies with less strong balance sheets. And I think the other feature which is of some concern is just the lack of transparency about this area of risk. When you think about the stress tests to which banks have been subjected, you haven't seen the same sort of rigorous testing of risk in this part of the market.
So, Ian, I wanted to ask you about your CFO survey, because I understand you've just launched your first quarter report, which you've completed recently. And really, this is the first survey that's been done of corporate and CFO sentiment since the Prime Minister's Brexit deal failed to get through the UK Parliament. What are some of the key messages you're seeing coming out of that during this really important period of uncertainty in the UK?
Absolutely. Well, we surveyed 90 CFOs, chief financial officers of the UK's largest companies in the wake of the failure of the Prime Minister's deal. What the survey shows is that CFOs are very, very focused on strengthening their balance sheets. So they are concerned about the outlook for revenues. Revenue expectations have fallen appreciably in the last year. They're facing rising cost pressures. That reflects the fact that wage growth is running at close to the highest level in 10 years. So revenue slowing, costs rising, and actually there are deteriorating credit conditions coming through in this survey. Not an acute deterioration, but the very, very easy credit conditions of the last 8 years have got slightly less favourable in the last couple of years. And CFOs are reacting to that with a very big focus on building up cash. So cash levels in the corporate sector are at the highest ever levels. Corporate cash has grown by 30% since the EU referendum. CFOs tell us that over the next 12 months they want to raise cash levels at the fastest rate in the last 9 years. They're also very focused on reducing costs. So I think the reaction to slowing global growth and Brexit-related uncertainties on the part of big corporates is to really double down on strengthening balance sheets and insuring themselves against uncertainty.
I wanted to come back to the topic of interest rates. And of course, you mentioned earlier that central banks are becoming increasingly cautious about pushing ahead with interest rate rises, given some of the more recent economic data that we've seen. Do you think interest rate normalization has gone about as far as it can go in the near term?
It's certainly on hold. And I think what is really striking is the absolute U-turn by central banks on monetary tightening, which has taken place over the last 6 months or so. We saw the Federal Reserve reassuring markets that rates were likely to be on hold this year. Indeed, now markets are pricing in a 25 basis point cut. In Europe, the ECB has gone from announcing the end of this phenomenal period of monetary ease driven by quantitative easing at the end of 2018, and then in March announcing actually more monetary ease. So a real change in the policy stance, which reflects the fact that central banks have been surprised by the pace of this slowdown. They're more worried about downside risk than they were through last year. And of course, these decline in interest rate expectations has helped ignite really quite a chunky equity market bounce in recent months. Now, my view is that the risks of monetary ease are greater in Europe than the United States. And the reason for that is that the US has a higher trend growth rate. Growth in the US this year is likely to be around about 2.3, 2.5%. In Europe, it's going to be closer to sort of 1.2, 1.3%. And actually, US banks are just in a better place than European banks. So I think the downside risks for economic activity and for interest rates and monetary policy are greater in Europe than in the States. And I think for all central banks, they're going to need a lot of reassurance about the nature of this slowdown, that it can be contained and it can deliver a soft landing before they start to switch to tighter monetary policy. So yes, for this year, I think the outlook is certainly rates on hold. And in Europe, the risks are that we get more easing.
All right. Now, Ian, we have a tradition on this show of asking our guests to make predictions. Now, I imagine that as chief economist, you get these kind of questions all the time. But what, in your view, is currently the most underappreciated macroeconomic risk to the financial sector that we and regulators should start paying a lot more attention to?
Well, I think it's an incredibly boring risk. It's just the economic cycle, and it's just what we know from a long history, which is the way in which very cheap money drives asset prices and leverage, and that you tend, as the cycle slows, as the growth cycle slows, to reveal the stresses and weaknesses in the financial system which were not apparent in the good times. So I think the risks are actually surprisingly kind of unchanged. I mean, where they pop up, of course, changes over time. But I think it's the good old economic cycle, which is the risk and its interaction with leverage and debt.
And one more thing before you go. It's all too easy, I think, for people in the regulatory community to sound gloomy about the future. Now, after all, it's the responsibility of regulators to anticipate and front-run risks before they crystallize. And of course, we've spent the whole episode talking about risks that we should be concerned about this year. But setting that aside for one moment, do you see any silver lining in the economy today or any reasons for us to be optimistic about our economic prospects?
Well, it's nice to be asked that question, actually, because I think that we do all tend to focus on downside risks, so not just regulators, but economists. And I think it's interesting to ask ourselves what the upside risks are. I mean, for me, a really interesting question is whether long-term growth rates in the West are going to prove as disappointing as the consensus and market currently thinks. Now, the consensus in the market have a fantastic track record of getting things wrong. And at the moment, there's a lot of pessimism about the long-term growth outlook, which is a function, I think, of demographics, of scarring effects from the financial crisis, and a perception that we're just not going to be able to grow productivity at the rates that we saw, say, in the 90s and early 2000s. What I do wonder is whether we're going to find ourselves surprised by productivity in the longer term for two reasons. One is that as we exhaust capacity in labour markets, so as unemployment falls, I think there'll be a greater incentive for corporates to use labour more sparingly and effectively, so I think that could drive productivity. And I think the other thing is that there's a really deep-rooted pessimism about the capacity of technology to raise productivity, and I think that's misplaced. I mean, we see technology is really changing the world all around us. It doesn't seem to be shifting the productivity numbers. We've been here before. We saw the same phenomenon of the 80s of frenetic technological change, not shifting productivity. I think this may be a question of lag. So if you ask me where I'm optimistic, longer term, I'm more optimistic than most about the outlook for both GDP growth and productivity.
All right. Well, ending on that slightly optimistic note, Ian, thanks so much for coming on Regulated Radio.
Thank you very much.
And there you have it. No shortage of things to watch out for in the months ahead. And while we may still face a lot of uncertainty in the economy, one thing is absolutely certain, and that is that the stability of the economy and the stability of the financial sector are very closely linked indeed. Now that means that regulators are going to have to pay very careful attention to these risks and consider how economic trends could affect the business models and resilience of banks, insurers, and other financial firms. Anyone looking to truly understand the performance of the financial sector would be well advised to do the same. But that's why we do what we do. That's why we bring you Regulated Radio, to make sure we're always discussing some of the most critical issues in the world of financial policy. Now remember, if you like the show, hit the subscribe button to ensure you receive notifications about new episodes. And if you're already subscribed, you can give us a review on your platform of choice or email us with your thoughts at regulatedradio@deloitte.co.uk. We would love to hear from you. And don't forget, if you listen to Regulated Radio and think, yeah, these guys are great, then do us a big favor and recommend the show to a friend or a colleague. You know they'll want to join the podcast revolution. But that's all for now. Thanks so much for joining us, and you'll hear from us again soon.